Welcome back to the channel. Today, we're diving into the exciting world of stock market investments. Whether you're just starting out or looking to expand your portfolio, understanding the different types of investments is crucial for building wealth. We'll be covering everything from the basics of stocks to more specialized investment vehicles. Let's get started. First up, let's talk about common stocks. These are essentially tiny pieces of ownership in publicly traded companies. When you buy a share of common stock, you're becoming a part owner of that business. As the company grows and becomes more profitable, the value of your shares can increase, leading to potential profits. Plus, many companies also pay dividends to their shareholders, which is like getting a bonus check for simply owning their stock. However, it's important to remember that stock prices can go down as well as up. This is why it's crucial to diversify your portfolio and not put all your eggs in one basket. Investing in individual stocks can be a great way to build wealth over the long term, but it's essential to do your research and understand the risks involved. Don't panic sell when the market dips. Stay focused on your investment goals and ride out the waves. Now let's move on to preferred stocks. These are kind of like the hybrid version of stocks and bonds. They still represent ownership in a company, but they offer a different set of benefits and risks compared to common stocks. One of the main differences is that preferred stocks typically pay a fixed dividend, which can be appealing to income-focused investors. Another key difference is that preferred stockholders have priority over common stockholders when it comes to receiving dividends and assets if the company goes bankrupt. However, this added security comes at a price. Preferred stocks generally have less potential for growth compared to common stocks. Think of it like this. Common stocks are like investing in a high-growth startup. The potential rewards are high, but so are the risks. Now let's dive into the world of ETFs, or exchange-traded funds. These are investment funds that trade on stock exchanges, just like individual stocks. But instead of owning a single company, ETFs hold a basket of assets, like stocks, bonds, or commodities. One of the biggest advantages of ETFs is instant diversification. For example, instead of buying 500 individual stocks, you could simply buy an S&P 500 ETF, which holds all those stocks in one convenient package. This diversification helps to reduce risk because if one or two companies in the index underperform, the impact on your overall portfolio will be minimal. Plus, ETFs are incredibly cost-effective compared to actively managed mutual funds. Think of ETFs like a pre-built diversified portfolio in a box. Next up, let's talk about mutual funds. These are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets, similar to ETFs. However, there are a few key differences between the two. Mutual funds are actively managed by professional fund managers who use their expertise to select investments and try to outperform the market. This active management can lead to higher returns, but it also comes with higher fees compared to ETFs. While mutual funds can be a good option for investors who prefer to leave the investment decisions to the pros, ETFs have become increasingly popular due to their lower costs and transparency. Finally, let's talk about REITs, or real estate investment trusts. These are companies that own, operate, or finance income-producing real estate properties, such as apartments, shopping malls, or office buildings. REITs offer a unique way to invest in real estate without actually having to buy, manage, or finance properties yourself. One of the main advantages of REITs is their high dividend yields. Since REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends, they tend to offer higher payouts compared to many other types of investments. However, it's important to note that REITs can be sensitive to interest rate changes. Overall, REITs can be a valuable addition to a diversified portfolio, providing exposure to the real estate market and the potential for attractive dividend income. Thanks for watching. If you found this video helpful, give it a thumbs up and share it with your friends. Understanding different investment types is the first step to building long-term wealth, and I hope this video has given you a solid foundation. Leave a comment below on which type of investment you're most interested in. See you in the next video.